Hello everyone, this is Professor Mohammed Adib, and today we are going to explain chapter 20, Cost, Volume, Profit Analysis from Horngren Financial and Managerial Accounting book. First of all, the learning objective of the chapter is to determine how change in volume affect cost, calculate operating income using contribution margin and contribution margin ratio, use cost volume profit analysis for profit planning, use CVB analysis to perform sensitivity analysis, use CVB analysis to calculate margin of safety, operating leverage, and multi-product break-even points. At the beginning, we are going to explain what are or how the changes in volume affect cost type. Before I go for that, I have to tell you that we have three classifications of cost. Actually, in the last chapter, chapter 16, you will find that we classified cost into manufacturing and non-manufacturing, and then to direct and indirect. In this chapter, we are going to classify the cost in accordance with the change in volume, which means some of the costs, like the variable cost, will change with the change in what we call cost driver. For example, number of units, other costs like the fixed cost that are costs that do not change. With change in cost driver, which means it will stay fixed, it will stay as it is. Variable cost means it is variable, it will change. So whenever the number of units will increase, the variable cost will increase. Whenever the units will decrease, the variable cost will decrease. On the other hand, fixed cost is remain fixed, which means the volume will increase or decrease, the number of units will increase or decrease, but still the cost is fixed. And we have the third type, which is the mixed cost. Mixed cost is cost that is part variable and part fixed. In order to understand that, I will start by giving a small, very simple example for variable cost and fixed cost. In the variable cost, I'm talking about, for example, marker that I'm writing with now, and I will assume that the only cost that change or matter to me is the cost of material. So whenever I will tell you that I'm producing 1 unit and these units are or is in need for variable cost per unit, that is $2, the total variable cost will be $2. If I'm going to produce 2 units and the variable cost per unit is the same, the total variable cost will be $4. If I'm going to produce 100 and each one will cost me $2 material, it will be $200 total variable cost. This means variable cost can be direct material, direct labor, and variable manufacturing overhead. All of these costs are changed with the change in the volume or the number of units produced. On the other hand side, we have fixed costs. Fixed costs like fixed manufacturing overhead, like rent, for example. Whenever I'm producing 1 unit and the total fixed cost is 1,000, for example, so the fixed cost per unit will be 1,000 because I have only 1 unit and I will load it by all the cost. If I have 2 units, then the cost will be divided into 2 units, so each unit will be loaded by 500. If I'm going to produce 100 units, so the cost will be $10. So in the fixed cost, whenever the units increase, the total fixed cost is fixed still as it is, but the fixed cost per unit is decreasing. So actually I can write a very interesting rule that you have to keep in mind regarding the variable cost and the fixed cost. Okay, in the variable cost I can say that total variable cost is variable, which means it change with a change in volume, and that variable cost per unit is constant. Of course, that cannot be right all the time because nothing to stay fixed forever. So actually here I will say that this rule is true within what we call relevant range. Relevant range, which is the period where the cost will stay as it is per unit. يعني for example, I purchase مثلا a container of raw material and this container costed me مثلا $100,000 and I have 100,000 kilogram of raw material, so each kilogram will cost me $1. As long as I'm getting the material from this container, the variable cost per unit will be constant. Whenever I will leave this container and I go for another one, maybe the prices have risen in the market, so actually I will start changing the cost per unit. So all what we are going to talk about during that chapter, that we are within the relevant range. The same is the fixed cost. We have two rules that we have to keep by heart. Okay, the first one, that total fixed cost is fixed, and the fixed cost per unit is variable, which means it changes, it decreases whenever the number of units increase. Okay, the fixed cost per unit decreases. Okay, again, this will be within relevant range. Within relevant range. Give me an example. The rent, it will be fixed, for example, for 1 year. In the next year, the rent will increase. So actually, the relevant range here would be during that 1 year. So both, okay, will be as it is. Okay, and we have to keep in mind that whenever we are talking about this part, we have to keep in mind these two rules. What about the mixed cost? We will go back for it later. And this is an example for variable cost. Variable cost remain constant per unit, as we said, but a change in total. And as you noticed, whenever I'm talking about variable cost, I will say its total is variable. Whenever I'm talking about the fixed cost, I will say the total will be fixed. So the costs are always attached to its total. And he gave me an example here, number of tablets produced. If I'm not producing any tablets and the variable cost is $55, the total variable will be 0, because 0 by 55 will equal 0. If I start by producing 25 tablets and each one will cost me 55, so it will be 1,375. If I'm going to produce 100, so 55 will be 5,500. And this is the depiction of the variable cost. As you can see, the x-axis is the number of tablets and the y-axis is the cost of batteries. So actually here, as you see, if I'm not producing anything, I have to start from the origin point. The origin point. And then as the number of units produced increase, okay, the cost also will increase. And of course this one will be the slope, which is the variable cost per unit. For the fixed cost, we said we have a total fixed cost. And as long as we are increasing the number of units produced, the cost per unit will decrease. See, this is why, again, if I'm talking about fixed cost, means total fixed cost will be fixed or constant. So remember, fixed cost, the total will remain constant, but the fixed cost per unit is inversely proportional to change in volume, which means whenever the number of units increase, the cost per unit will decrease. And this is the depiction of the fixed cost. It will be a horizontal line parallel to the x-axis, which is the number of the tablet produced, because as long as we are within the relevant range, whatever the number of units will be, the fixed cost will remain as it is. This is a table that's summarizing what we just said. Variable cost is change proportionally to change in volume, as we said, and the per unit is remain constant. Fixed cost, the total will remain constant, but the cost per unit will inversely change to volume. And here come the mixed cost. Mixed cost means we have part of the cost that is fixed and another part that is variable. Give me an example, realistic example, like for example مثلا the personnel salary, the sales personnel salary. If you know any personnel salary, he will say to you that I'm receiving part of my salary as a fixed salary, 1,000 for example, and a percentage of the sales to be achieved by these sales personnel. So his salary will be the addition of both. The addition of both. This is why I can say that the product cost will be total variable cost plus total fixed cost, or the cost per unit will be the variable cost per unit plus the fixed cost per unit. Here he is giving an example related to an invoice of a cellular or a mobile phone, that it's saying that we are paying a fixed amount cost, which is $100, and whenever the number of minutes are increasing, the total cost is increasing as the total variable will increase. يعني here he is saying that the minute is costing me 0.10, so actually I talked here 100 minutes, so I will pay the 100 plus the $10. How did I get the $10? 100 minutes by the rate, which is 0.10. Again, if I'm going to talk 200 minutes, I will pay the 100, the fixed part, plus 200 minutes multiplied by 0.10 and so on. Okay, so this is mixed cost type. Actually, mixed cost or total cost can be depicted as this. I here combine the variable part with the fixed part. If you noticed here, we didn't start from scratch, because even if we are not producing any of the products, we still have to pay the fixed, which is the rent. If I'm renting a factory, for example, I will pay the rent all the way, no matter بقى if I'm producing or not. If I'm going to produce, then I will be costed the other material, labor, variable overhead that is related to the production. So actually here, I will start by the fixed cost, and then I will start the variable cost from here, and then I will go up. So actually this part is representing the fixed, this part is representing the variable. The total cost is the addition of both. One of the very interesting methods to be used in relation to the mixed cost, or specifically as a method to separate mixed cost. What do I mean by separate? If I have a total cost or total mixed cost, and I would like to know how much of it is variable and how much is fixed, the high-low method is one method that can be used to separate the mixed costs into variable and fixed. And it is called high-low method for a good reason, because actually it depends on the historical data of this cost. يعني for example, I'm talking here about a total maintenance cost, and I'm saying that at first quarter the cost was 1,630 when we used to produce 360 tablets. We have the second quarter, the third quarter, the fourth quarter, okay, and the factory manager wanted me to separate these costs into variable and fixed. Then I said, okay, I will get this historical data that already happened, and I will start applying the high-low method. The high-low method have 3 steps. The first one is to calculate the variable cost, per unit. 2, to calculate the fixed cost, and then to construct what we call cost function or cost equation that we can use to make an estimation of cost in an activity level that is not mentioned here. طيب, let us understand what do we mean by cost function. Cost function is an equation that is written in that way, that is telling us that the total mixed cost equal to A, which stands for total fixed cost, B, which is variable cost per unit, X, which is cost driver. What is cost driver again? Any factor that is causing cost. يعني if I'm going to calculate the cost that is measured per hour, so the hours, number of hours, is the cost driver. If I'm going to calculate the cost based on the number of labor hour, then the labor hour will be the cost driver. If I'm going to calculate the cost based on the number of kilometer, so the kilometer is the cost driver. In this case, and up till now, we are saying that the number of units or the volume is the cost driver. So my main aim here is to find out, to construct a cost function like that. So whenever I would like to know the estimated cost of a specific level of activity, I will substitute by this level of activity on X. طيب, here, how to do that on that example? I will start by selecting highest and lowest cost driver. And be careful, I said the highest and the lowest cost driver. I didn't say the highest and lowest cost. Cost driver here is the number of tablets produced. So I selected this point and this point. This is the highest and this is the lowest. And I will start solving. The first step is to find out the variable cost per unit, as we said. How to find that? I will say B equal to highest cost driver minus lowest cost driver. And here I will use the cost corresponding to the highest and the cost corresponding to the lowest. I didn't say the highest cost and or the lowest cost. I said I selected the highest cost driver, then I got the cost that is corresponding to it. And then I selected the lowest cost driver, then I selected the corresponding cost. And this is what I did. Okay, I said that the highest point was 480 and the cost was 1960. The lowest cost driver was 240 tablets and the corresponding cost is 1480. So the variable cost per unit B equal to $2. This is the first step. Type. The second step is to calculate the fixed cost. But how to do that? By substituting, because actually after I got that B, I have a cost driver that I can write it in that way. $2x, because I got the variable cost per unit. So I will substitute in step 2 in this equation in order to find A. طيب, I will use only one of the 2 units that have been used in step 1. I cannot use any other points. And both, if I use the highest or the lowest, they will give me the same answer. So I will do that here. I said that y equal A plus 2x. Type. I selected, for example, the lowest, or sorry, the highest. Both will give me the same answer again, 480. And I will say the cost is 1960. A is unknown, plus 2 multiplied by 480 tablets. Then I will move that to the other side, and A, I will solve it for A, so A will be 1000. So now I have a cost driver. This is number 3. I have a cost driver that can be written like that. Y equal to y equal 1000 plus 2x. So this is number 3 where I constructed or created the equation that I can substitute at. If I will ask you now, what if we are going to produce 500 tablets? Did we have this level of activity here before? No, the maximum was 480. And now I would like to estimate what will be the cost if I'm going to produce 5,000 tablets. So the cost will be 1,000 plus 2, okay, multiplied by the 500 units or cost drivers that I would like to estimate the cost for. So it will be 2,000. So the high-low method includes 3 steps. The first one is to calculate the variable cost. The second is to calculate the fixed cost. The third is to construct the cost function and then to substitute by whatever the level of activities that you would like to do. Right. The last thing before we move to a new point in the chapter is the relevant range. As we discussed before, relevant range is the range of volume where total fixed cost and variable cost per unit remain constant. And pay attention, he said total fixed cost because we said total fixed is constant, right? And we again said that the variable cost per unit is constant. He is saying nothing is constant forever. As we said before, we have relevant range. So if my capacity, for example, in the factory is 2,000 units, so whenever I'm producing unit 2, 3, 4, up to 2,000, the cost will be fixed, the rent will be the same. But if I'm going to produce more than 2,000 units, I will need to rent another machine. So the fixed cost will increase. And then then we will have a new relevant range. After this relevant range is reaching its maximum, then we will start moving, and in some books we call it a step cost. Why step cost? Because actually it is like the stairs. This is step 1, step 2, step 3, and so on. Perfect. I move now to another interesting part, which is the contribution margin. As you know, we have a traditional income statement that we studied in chapter 16, and chapter 16 is recorded and you can go back for it and see how this traditional income statement in details. But traditional statement was like that: sales minus cost of goods sold equal to gross profit minus operating expenses equal operating income. And this is the format that we used in chapter 16 when we used to classify the cost into manufacturing and non-manufacturing. طيب. Now we started to classify the cost into variable and fixed. So this traditional format will no longer be valid. So we have now what we call contribution margin income statement. Contribution margin income statement. طيب. It will start by sales, but then I will start covering first the total variable cost. To get what we call the total contribution margin. Total contribution margin minus fixed cost or total fixed cost equal to operating income. This is what we call contribution margin income statement. Okay, طيب. Let's go and see how this statement will help me to take decision. طيب. Let me give you an example, numerical one. I will erase this one because actually, as I said, it is repeated from chapter 16 and we don't need it anymore here. But actually, I will start asking you, what if I would like to break down this income statement into its component? يعني for example, sales, how sales can be calculated? It is quantity by selling price per unit, which is the selling price. طيب. If I assume that I'm going to sell 100 units at $10, so the total sales will be 1,000. And then I will go for the total variable cost. Again, it will be the same quantity multiplied by variable cost per unit, which is 100 units at, for example, $6, which is $600. So the contribution margin will be $400. What is contribution margin? Contribution margin is whatever is remaining from sales after covering the variable cost, which will start to contribute in covering all or part of the total fixed cost. This is why it is called total contribution, because it contributes. It may cover part or all of the fixed cost. Very good. So I can say that the total contribution margin will be or can be calculated by Q multiplied what we call contribution margin per unit. How should I get the contribution margin per unit? Contribution margin per unit is the selling price per unit minus variable cost per unit. Okay, very good. And then another thing that we have to keep in mind, that we have something what we call the contribution margin percentage, and this is a very important to be taken into consideration. Sales is the main number in the income statement and we always consider it as 100. So now sales is representing 100. If I'm going to represent variable cost as a percentage of sales, I will divide the 600 by the 1000, which is 60%. So the variable cost is representing 60% of the selling price. So whatever the selling price will be, the variable cost will be 60% of it. Then the contribution margin will be representing 40%. How I did that? In two ways. I can do it like that: selling price per unit minus variable cost per unit over selling price per unit. Or I can do it in total. Total sales minus total variable cost over total sales again. So the contribution margin percentage representing خلاص يعني if I'm going مثلا to change the price into 200 units and I will ask you what is the contribution margin percent, I will say it is 40%. Why? Because variable cost خلاص per unit is fixed. So whatever the selling price will be, the same percentage will be applied. طيب. Then I will go to the total fixed بقى. The total fixed احنا هنا we will have three alternatives. The first one that the fixed cost will be 300 for example. So actually the operating will be 100 income. طيب. Maybe it will be 400. So actually the operating income will be 0. And maybe it will be 500. So I will have an operating loss of 100. Whatever is between brackets is either loss or expenses. طيب. This point is what I'm interested at. The 400 that yielded me 0 operating income. This is what we call break-even unit. What is break-even unit? The number of units that will make the operating income equal 0, which means I'm neither making loss nor profit. I'm just covering my cost. I'm just covering my cost. Okay? So now, if I'm going to do that, I have to know that the contribution margin is the difference, as we said, between sales and variable cost. And it is called the contribution because it's the amount that contribute to covering fixed cost. And this is what we just said. Right. Actually, how the unit contribution margin or contribution margin per unit is calculated, it is selling price per unit minus variable cost per unit. Okay, type. If I would like to make the ratio contribution margin over sales, and this is what we said before, selling price per unit minus variable cost per unit over selling price per unit. Or in totals, I can do it. Total sales minus total variable cost over total sales. And it will give me the percentage that I'm looking for. This is the comparison between the traditional income statement and the contribution income statement. As we said here, cost of goods sold will include some variable and some fixed. The period as well will include some variable and some fixed. Here, the variable cost will include some product and some period. If you'd like to know the difference, please go to chapter 16, as I said before. Here, the fixed cost will include product also and fixed product and period cost. Right. What can I use that for? I can use it to conduct what we call cost volume profit analysis. Cost volume profit analysis, which means it is very important for the company before starting its operation to know exactly how much or how many units should it produce in order to find out that operating income is equal to 0. Yani for example, if in our previous example, I said 100 unit is the break even. So actually, I know that I must produce more than or sell more than 100 units in order to achieve profit. Please don't go below 100 units. Why? Because actually, this will cause you to achieve loss. يبقى this is one very important خلاص issue or advantage for using the variable and fixed cost and the contribution margin income statement. طيب I will go for that cost volume profit analysis for profit planning but in the second part of the chapter, so please stay tuned. Thank you very much.